Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, it's the Advanced Insurance Sales Series, and on today's show, long-term care, to insure or self-insure. And with me today is nationally recognized advanced sales expert and creator of Insmart, Bob Ritter. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, Bob, welcome to day 5. You've been here all week. How do you like that?
Enjoying it.
I appreciate it too, and I'm so you're a patriarch in our business. There's no doubt about it. You've been around forever. You have been, I don't know how many. I got probably 2,000 conventions and speaking under my belt. I have no idea what yours is. It has to be in the 5,000 to 6,000. I don't know, maybe more.
I got over 4,000 when I counted it the other day.
Unreal.
It's the best I can reconstruct it.
Well, I so appreciate your longevity in our business. You've contributed as a teacher, a mentor. You're one of my biggest patriarchs that I look to. I mean, there's about 4 or 5 guys that I say, you guys are the best, and you are one of the best. And to me, I really appreciate what we're talking about today because this is a difficulty. People keep thinking, I keep reading, and I wrote an article myself, so I can't really exclude myself. I wrote an article saying the number one risk to retirement is human longevity, living too long. If we're going to live too long, the baby boomers now need to wake up. This is my generation I'm talking to. We are going to need probably some assisted living, at least at home, because we're going to be living so much longer than we originally projected from our previous generations, our parents. So when I'm looking at this, people are still arguing this in their head. And this is why I like bringing you and your Insmart product, your Wealthy and Wise product. I want you to argue this in your mind by the basis of math with good assumption. And look at these numbers. Should I go ahead and buy a long-term care policy, or I have enough wherewithal, I'll just self-insure? Bob, answer that question because that's a big debate out there right now.
Well, it's tempting if you don't know the math.
Mm-hmm.
And there's an analysis you can do which will tell you the math. It doesn't always point one way or the other. I've got an example here where it points towards acquiring the long-term care, and I don't think it's an unrealistic example. The question is, from a pure mathematical point of view, will you spend more of your money self-insuring or more of your money buying life insurance if the claim occurs? Obviously, the best thing to have is no claim and no insurance. But I'll even compare that. You'd be surprised at where that fits into the slot, too.
Well, many of our consumers, our advisors are usually pushed back on long-term care because they say, hey, I just can't afford it.
Well, that's another. If the dollars aren't there, obviously you don't buy it. But if it's a question of voluntarily not buying it, because it doesn't look like it makes any sense.
Yeah, I have money. I have plenty of money on the side fund. I have reserves. Do you think clients really think through, if I run into the problem, I'll just pull from my cash reserves? Or if I say to my client, do you want to treat your money with the best possible stewardship that's available? And if I can show you that through mathematics using Wealthy and Wise or Insmart, if I can show you that, the mechanics, and look at the real statistics. And by the way, remember, every state's different what you're going to pay on long-term care. And whether you're using a reimbursement policy or an indemnification policy, it's all over the board. So before you even make your decision to buy long-term care or self-insure, remember, you need to know your state's numbers and what those numbers are going to be like, and look at the projection of those costs, maybe with a COI or an inflation base. So when I'm looking at this, I don't want to pay for medical insurance, but I have it. I don't want to pay for disability, but I have it. Long-term care, I'm trying to think about my lifestyle, maintaining it. And I have to say, just a little side note, anecdotally, I visited a state-run nursing home. I did not like the lifestyle of a state-run nursing home. So I'm thinking, hey, I definitely want to have this coverage. I do have it myself, Bob. And by the way, just for my listeners, I have a full policy. So I'm not even using linked benefits. Talk a little bit about the mechanics, because you said something very interesting to me that was shocking. You could buy a long-term care policy and linked benefits, and you said, bottom line, the dollars may be very similar when you do the numbers. And that surprised me.
Yeah, well, we ran the numbers. Net worth, wealth to heirs, they came out very close.
So really, there's not that really, I think of this yin and yang, I think, well, I'd rather do linked benefits because if I don't use it, I don't lose it. But you're saying the mechanics of the math say they're pretty much even, Steven.
Yes.
See,
which actuarially makes sense, doesn't it?
Well, yes. In my mind, that mechanics on the actuarial side makes total sense. But when I'm thinking, when the client or my advisors are saying, why would I do that when I could stick it into an annuity with an LTC provision in it And if I don't use it, I'm not on any money.
I have no argument with that. I don't. That's a perfectly logical alternative. I didn't use it here, but it's a perfectly logical alternative and one you can engage.
Now, we could use your system, right, to calculate that. Let's look at long-term care standalone policy. Let's look at a long-term care linked benefit policy. And let's do the one, I like yours. You even said, hey, let's say no claims occurred and you didn't buy any LTC, anything.
Right.
Let's compare those three and see what it is on a natural timeline.
Now, a brand new user with our system might need some help putting that case together. We've got referral partners all over the country that can help them do that.
Don't you have mentors that help you out? If you decided to do this, maybe it's overwhelming. You look at the software and you go, oh, how can I do this? But you have people on the phone. When you become part of the subscription, you can do that. Is that correct?
Yep.
Well, I think that's a huge thing to know that, hey, listen, you're saying, Steve, I love everything you guys are doing. I just can't see me doing it. Well, they have mentors out there to help you, walk you through all the inputs and understand. And remember, a lot of these people have been doing this for how many years? Some of your mentors.
Oh, not 56, but
yeah, but I
30.
mean a long 30 years. That's a long time. To me, comparing this, because I really think this is going to be the bugaboo later on for boomers. They're going to sit there and wish they had some kind of coverage, and I think at least at the minimum, we're going to be faced with assisted living. I think that's really a reality now. When we come back from the break, we're going to continue our discussions on whether to purchase long-term care or self-insure with our own cash retirement reserves. And don't forget Bob's free trial offer to take Insmark for a spin at insmark.com/free offer/ash. And remember, you can sign up for our 30-day free trial offer from Backroom Technician at brtnow.com/trial-signup.aspx. We'll be right back after the break.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life from one of the largest distributors of indexed universal life, Ash Brokerage.
Well, welcome back, everyone. I'm Steve Savant with Bob Ritter. And remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, at ashbrokerage.com. As soon as you come out to our homepage, just click on the logo, and it'll take you right out to our archives. And just a heads up, before moving forward with any of the ideas on the show, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance department. Well, let's get down to business. We're discussing whether purchasing long-term care or self-insurance from our cash reserves is the way to go. Well, let's get into this. I'm looking at this again, and I love this because I already mentioned this just in the last segment. Strategy 1, 2, and 3. LTC purchase, no claims. We didn't purchase a policy. We didn't have any claims. Then we showed no LTC insurance policy, but claims costs and withdrawals from our net worth. And then we also showed long-term care insurance. We purchased it, and the cost paid by the insurance company, and we looked at the net effect of all three scenarios, which are basically the three that we're going to look at when you talk about extended care. And by the way, I've noticed this, and just from a heads up from an advisor point of view, I've noticed the nomenclature of our industry is changing from long-term care to extended care. I think people kind of see that now as more of a consumer-driven kind of phrase that really works well. Well, now when we look at this, Bob, I'm looking at the basic assumptions that we have here of no LTC. I never had an event, so I didn't have to pay for a policy. It was great. And I don't know how many people actually live that scenario in our geriatric, in gerontology. But 2, I didn't purchase a long-term policy, and it came out of my retirement or my equity or my net worth. That is a major issue that happens today. So that occurs. And then the last one, long-term care purchased, and I had the claims paid by the company. Let's just look at the graph, because I think, again, this tells the story. Walk me through these two graphs. The first one, the net worth.
The assumptions that we used here are really important. It assumed a level of claims, and also assumed that this couple needs a certain level of retirement income. We assumed that when one of them is in claim, that retirement cash flow decreases by 25%. Could be 20, could be 15, could be 30, but obviously one lives a little less expensively than 2. That's part of the key to this, that assumption. So the top graph shows, believe it or not, that the best strategy of all is to insure it. You end up with more net worth if you insured it than if you didn't buy it at all, which doesn't sound reasonable at all. The present value of the reduction of lifestyle costs is much less than the present value of the premiums.
And in my head, when I know you said
It's
that.
the only reason it can work. It's
Right.
because they're the only two offsetting items in the two calculations.
And I would not have thought that. If I didn't know I can go to this software and prove this out, I would not have thought that way. And I'm sure there's clients, customers, and advisors that are doing the same thing I'm doing, which is without a software package to show me this, I would have said, no, intuitively, I'll just pay it out of my cash reserves if I have to face it, and it's way better to do it that way. But really, when you do it, this proves it out. This is why I'm thinking the longer we live, the longer the timeline. Talk about, though, the difference between the net worth and the wealth to heirs, because the longer we live, this really compounds.
Well, sure. Obviously, the bigger the green, the better the green to the heirs. That's just follows.
Well, I'm thinking when I'm looking at the difference between the net worth that I have and what I'm handing to my children, more than likely, my grandchildren, that spread is so big. I mean, we're talking about a difference, looks like here, if I'm reading the graph right, a couple mil.
Almost.
Yeah, almost a couple $1 million spread difference. To me, that's where this whole thing of Einstein's theory of compoundedness, that really takes over. When you look at retirement, the longer we live, those numbers get major. I don't think they're exponential, but they're definitely geometric.
Well, and the logic is also working. It's more efficient to, as opposed to not having any claim at all and self-insuring. Self-insuring, although it's not as good as insuring, it's better than doing nothing because of that present value differential between the costs and the savings of one person in claim.
When I'm looking at the premium difference, whatever I'm giving up, the actual payouts during claim are going to supersede my cash flow. I'm not going to sacrifice my actual lifestyle at all on this.
This couple's, I think, required $100,000 a year. And the long-term care policy was somewhere around $12,000. To most people, that means I don't have 100 anymore. I only got 88. We bought all of the policies and all the claim costs out of net worth. It's an asset purchase as opposed to an income purchase.
Do you think people make that distinction as an advisor?
No, not near
Okay,
enough.
well, let's make sure we say that again, because I think that is a huge mistake, and this is an educational moment for a lot of us. We're taking this out of income. And that's the mistake. It should be being taken out of assets.
Everything we talked about is an asset play. Everything.
Because that's where the game is played. And when I think about the actual net number, that's what I'm looking for. So we're not taking this, we're trying to look at the difference between hard assets and assets that are income assets. And I think that difference of pulling money from the right asset base is so critical to make these numbers
Even
work.
if you invade principal. Even if you invade principal. Because a bad asset needs to be spent.
When you give me on our way out of this segment, definition of a bad asset.
Money in the mattress.
Sitting in my money market account?
Yeah. Well, 1% is better than nothing.
Right.
Right.
How much is there? You think people are got money in their mattresses anymore?
No. My wife has a little in a jar.
In the jar. Wow. Well, I just want you to know that this broadcast is all over the internet, so I hope your security, your home's okay. Bob, I want to thank you for being here all this week. It's really been beneficial. You're one of the patriarchs of our business. Wealthy and Wise and Ismark is a boilerplate issue that every guy that's doing business, every gal in our practice needs to have. Well, that's our show for today. Remember, you can read all my online insurance news commentary, advisor blogs, and articles on Producer's Web, as well as my answers to consumer questions on the Insurance Library. And don't forget to view any of our past episodes at our on-demand section located at www.downtobusiness.ashbrokerage.com. So don't forget to follow me on Twitter, Facebook, or LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor.